Thank you all for attending. Today we're going to talk about trade management, perhaps the most important aspect of trading. I know everybody likes to talk about getting into the market, but managing the trade is much more important. So obviously we're doing this today with a view to improving how you manage your trades, and also obviously so it positively impacts your profits. Now the good news is that for most traders that simply wait for their stop to get hit before exiting a bad trade, there's lots of room for improvement. In fact, there's so many things you can do to improve upon managing by price alone that it's actually better to take these ideas one at a time. So we'll talk about a number of things today, and it'll be better to master one at a time until it becomes second nature, and then look at the next one. Now before we look at specific techniques, let's have a think about exactly what it is we're trying to improve. Now the trade improvement process basically involves a study of the elements of a good trade, but also ignoring the elements of randomness, because randomness is something you really can't improve upon. Now, any market can only go up or down. And one of the things that trips people up is that when you exit a trade, the market can still only go up or down. In other words, you're going to exit some trades that then go your way. Okay, it happens to you now, it happens to everybody. Sometimes the market hits your stop, and as soon as you get stopped out, it then goes the way you thought it would. But when that happens, has that actually got anything to do with your trade? So when it hits your stop and turns around, does that mean your entry was really good and that your stop was bad? Do you even know? In fact, is there a way to know? Well, I think there is. And it comes down to every trade having a premise. So when we enter the market, we do so because we have a premise, a reason to enter that market at that time. So the premise might be, I thought there was going to be a breakout and a stop run. It might be, I saw sellers trading to a low and get stuck, so I bought the market. It could be something more abstract, like I saw two lines cross on my chart, or there was a full moon. But whatever the reason we entered, we had a cause or a premise or a reason. We thought the market would react to that cause, so your trade is effectively over when it is shown that this cause didn't create the reaction you thought it would. And if you look at it that way, you won't feel so bad if just by randomness the market moves your way after you exit. In addition, any signal to enter the market is going to have scope. Now for example, if you're day trading the S&P 500 futures, and the market was moving down and you bought it, you could reasonably expect a move back up of 10 to 15 points on the day as an intraday trader. And that's about the size of an average intraday trend at the moment. Now let's say you're a regular day trader that exploited these moves, and one day you decided to hold the trade for a week. You're getting in for exactly the same reason, you hold the trade for a week and you make 100 points. So you enter in for the same reason that would normally give you a 10 to 15 point trade, but you just made a random decision to hold the trade after entry. Would it be luck or good judgment that got you that 100 points? Or how about a trade where you normally had a 4-tick stop and target? You kept moving your stop as the market moved against you, and in the end the market went 100 ticks against you, and you kept the trade until 2 days later it came back and hit your target. Is that your trade working out? Well, no. That 2 days of activity was nothing at all to do with the reason you got into the market. So you get into the market for a reason, the cause that you believe will have an effect, and that effect is only going to move the market so far and for so long. And if you hold a trade past that point, you're basically reverting back to randomness. So the point here is there's going to be a natural tendency to feel that you didn't manage a trade well if the market moves your way after you exit. So you might decide to hold on then to bad trades too long because you experienced this. To tell yourself that you need to improve your management so that the market never goes your way after your exit. And really that's setting yourself up for an impossible mission. Now this might be a bit confusing, but it's important to understand this so that we can set realistic goals for management. So let's have a think about this. If you could guarantee that the market never went your way after you exited a trade, it would mean there's a point in time where you know without doubt where the market is going. Okay, and that also means that at this particular exit point, you could actually, instead of exiting because you know exactly what's going to happen, you could enter a trade in the opposite direction because you know 100% of the time what will happen next, and you could make money 100% of the time doing that. So you wouldn't exit trades, you would simply always reverse them because you would always know without any doubt that the market is about to go the other way. And we all know that winning 100% of the time is simply impossible. So trading is a game of probabilities, not certainties. So let's just agree there's a degree of stuff happens after we exit a trade, that if our premise is not correct, that there is no edge in what happens afterwards. So if we stay in a trade too long as well, we'll also revert to randomness, which again has no edge. Okay, and of course too long depends on your reasons for getting in the first place. Now when we revert to randomness, we should basically expect the random part of the trade to break even before fees and lose money after it. In other words, there's no edge in moving into that random portion of a trade. So what we've got to exploit, we've got to exploit what our edge gives us and then get out of the trade. So a good trade is simply one where we expected to get a reaction and we got it. And a bad trade is one where we didn't get that reaction. But a well-managed trade is where you reacted based on whether the market did what you expected or not. And a poorly managed trade is one where you panicked and exited early, or you held on to that position just in case the market came back. Now, whether you agree or not, I hope that has stimulated some thought just about the realistic goals of trade management before we go into the details. Now here are the elements we're going to look at today. I'm not going to dwell on this too much other than to say you're going to be looking for something fairly obvious in each one of them. So trade management is not rocket science. It's just looking at additional elements to help you make a decision in the heat of the moment. Now the one we're not going to focus on too much is actually the price, because I would guess you're already looking at that. What we are looking at is also not meant to replace, it's not meant to replace a hard stop or an emergency stop. What we're doing is helping you make a decision before that stop gets hit. Now we're going to look at two trades on crude oil, and let's quickly walk through the elements we're going to use to help us manage the trade. So on this tool here, this is called the depth and sales. We can see these center columns show us what is trading right here, right now. So we've just got into a trade. These columns have been cleared automatically on all three of these depth and sales. And that's just a feature of these particular tools. So once in a trade, we end up just looking at what has traded since we entered. This will become clear in a few more slides. Because what we're interested in when we're managing a trade is really just what's gone on since we got into the market. Now these columns here are where we look for momentum. And the best way to think about momentum in respect to trade management is that once you get into a trade, you're looking for a pop or a sustained one-side move in the market, and you want to see that on your side. You don't want to see that against you. And once you have the market pop in your direction, you have a much higher probability of the trade working out, and then you can relax a little. Now that pop is of course relative and is bigger on more volatile markets. And if there's no pop, and you have a lack of momentum, if the market is balanced and going nowhere, then the clock starts ticking. So let's say your typical trade sees the market pop within 3 minutes of entering, then you get into a trade and after 30 minutes the market's still moving sideways. In my opinion, that trade has failed. You didn't get the reaction you wanted, and now the trade has become a coin toss. It's become a random trade. So for momentum, we want to see it on our side, we don't see it against us, and if it is completely absent, we should consider that eventually our premise for that trade has failed. Now the balance of trade we see in this meter here, it's showing the total buy market orders in blue. We don't see any blue on there right now because it's reset, and total sell market orders in red. We just got 2 sell market orders. And again, this has reset itself when we entered because again, we're interested in the balance of trade since we entered the market. High volume nodes we see over here on the auction vista chart. So we can see this cluster of circles here, around 53.72, and we can see on the right that we've just tested that area and it's held. Now these high volume nodes simply represent areas where there are an above average amount of positions. So while this area isn't that significant from a price chart perspective, it is significant in terms of position. So the theory is that if we now move up through this area, the shorts that entered here are going to get stopped out, and that in turn will make the market pop up. On the other hand, last time we came back to the area, it did hold. So it is a line of the sand in the sand as we move back up there. So if we get back up to this price and start to move down again, we will be in profit, but we will be in danger of the market moving against us rapidly. If we get through this area, we'll be very comfortable because the seller stops will generate some upside momentum, and we should be able to hold that area if we come back down and test it again. Now large traders are visible here on the reconstructed tape, which is showing the large trades for the past 3 minutes only. Now it's nice to have large size on your size, but what you really want to see is size stuck. In this case, what we can see a lot of selling from 53.67 down to 53.63, and now the markets are starting to turn up. So again, that gives a scenario where those sellers from 67 to 63 could potentially start to get stopped out. And finally, we have correlated markets. In this case, I'm using two of the depths and sales, two of the trading domes, to let me know where the mini crude here and natural gas are going. So we use correlated markets for a number of reasons. First of all, arbitrage does keep related markets in line, and you often get one or two markets breaking before the one that you're trading breaks. Now that doesn't mean we'll have a market that always leads, but there will be times where there's a clear leader. Now, so you're not watching correlated markets just to play follow the leader. Now if related markets are all doing their own thing, that points to an overall lack of activity in the markets, and an active market will see all related markets moving well at the same time. An inactive market could, for example, have one market moving up, one market moving down, and almost certainly in that case you'd have your market moving sideways lazily. Now some markets are slower than others, but again, don't expect the fastest market to always be the leader. So you do have to make adjustments when using a slower market, and what we can see here, the mini crude here is a slower market, and the natural gas is actually faster, and then we've got crude, the market we're trading in the middle. Now this white line across here on the depth and sales, that's the center line. And once again, when we entered the trade, all of these depth and sales recentered. And again, just to give us so we can have a visual clue of where all the markets were. So all we're interested in here is whether these two related markets are up or down relative to that center line. We are not interested in any of the numbers on here at all. We're just interested in how much this has moved. Now you could use charts for this, and we will see that later, but the domes do have an advantage of recentering when you enter, and you can't really set a chart to recenter in the same way. Now in this first trade, it's not long after the 9 AM open on the crude market. We'd moved down, into the open, and we tested the low moved down here, tested the low 1, 2, 3 times. So this trade here is a simple pullback trade based on the premise or the presumption that the market has actually reversed already, and that this is just a pullback, and that we should now see some momentum to the upside. And if we look below us, we can also see an area of buy-side liquidity here and here. So again, if we do move down, that gives us some support theoretically as well. Okay, so here we are, 3 minutes into our trade. We've got an entry price at 53.66. Now remember, we're going to have to do this analysis while we're in a trade. The pressure is on, and you need to keep things simple. So let's go through our elements once again. So we did tick up to 53.67. We can see 4 printed there. But now we've moved down, and we're now 3 ticks below the entry price. Now, as you know, crude is a fairly volatile instrument, and moving down 3 ticks in 3 minutes would really not represent any kind of move or pop or momentum in this particular market. So from a momentum perspective, we don't really have a signal either way for us or against us. In terms of balance of trade, we've got 371 sell market orders and 327 buy market orders, and that's still, once again, fairly balanced, nothing to see here. Now we do have an area of high volume here to the left, which is quite spread out, and I'd say that at this point you would not have to worry about the traders there stopping out yet, because obviously if they were going to stop out on a move down, they would have done it here or here. Okay, so again, from that perspective, absolutely fine. If we look at the large traders here, they do appear to be against us. Now previously, we talked before, we'd seen large traders down to 53.63, and they couldn't go any lower, and once again, that's basically repeated itself. So I would be nervous here to see large sellers at 62 and 61, because we haven't seen large sellers there before. So again, this is a little bit of a red flag. And the correlated markets, well, we can see that the least volatile market, the mini crude, has moved down a tick, and the more volatile market, natural gas, has moved down 4 ticks. So this means we have a healthy active market because everything's moving in sync, but you know, we're not really seeing a sign that the markets are going to break. So if natural gas here was down 15 ticks, absolutely would consider cutting the trade. Now the bids below us are still quite big, but again, we won't know if they're really real until we move down there. So this white line here is just basically showing us a representation of the bids, which we can also see 53.58 here. So for now, what we're looking at is that price has moved against us, but the other elements that we're looking at to tell us how much strength in that move down are basically saying it's a neutral market, it's mixed. Now on crude, we have to think about what kind of, if we're going to benefit from trade management, we have to think about what would be a reasonable stop loss on crude. So 10 ticks on crude is a reasonable stop loss, and that would be, just below the day's low, and also just below this area of high liquidity here. So that seems about right, especially considering we've got our first targets at, 12 and 20 ticks. So the 10 tick stop is kind of average for crude, and that's really what we need to beat on a losing trade. Okay, so here we are 3 minutes later. So let's look, do we have momentum? Well, I think in this case we can say we do. So if we look at the total amount of trade on the buy side as the market moved up here, we got this 20, 19, 35, 6, 28, 22, 18. We've got some decent size hitting into the bids, into the offers, sorry, and we've got price progressing up. These blanks on the other side show that as we moved up, we occasionally backtrack a tick, but stayed there for such a short time that we didn't get a chance to trade a single contract on the sell side. Now that would require a more in-depth discussion of how these columns work, but just be assured, decent numbers on the buy side and kind of holes on the sell side is a good indicator of upside momentum. Now this isn't the fastest, most one-sided market ever, but this is decent momentum. If we look at balance of trade, we can see we've now got a decent imbalance. So since the entry, we've got 1,296 sell market orders, and we've got 1,652 buy market orders. Now crude tends to show less of a percentage imbalance than markets like the S&P 500. So there you'd expect to see 1.5 to 2 times buying compared with selling in a momentum move up. But for crude though, this is actually decent side, this is good. In terms of high volume nodes, well, now we're at one. So we're at that level. We saw a lot of high volume trade previously, and it should be no surprise that if we look here, we've traded 156 contracts into the offer at 53.72, and we haven't moved up. Now it's normal for us to see high volume trade where the market traded high volume previously. And what we can see in this case, we've actually got an iceberg order here on the offer side. So we can see that 84 contracts have been added to the offers as buyers traded there. Now we do have a little room in the trade, so we've got an entry price at 66, we're at 72, so we've got some breathing room. But this potentially, this here, this 156, is potentially the end of our trade. So if the sellers hold this, so what we've got here is people are buying but the price isn't moving up. So the offers are holding it, and if they do hold this and we start to tick down, there is a good chance of a swift move down as the buyers see that the up move has failed and then get out of the market. So if we do start to tick down from this high volume area, we'd look to cut the trade. On the large trader side, we can see a lot of green. The trouble is it's a lot of green that has bought 53.70 to 53.73. So for now, again, those traders, those buyers, are not getting any price progression for their efforts. And as I said before, it's nice to see big trades on your side, but more informative is when large traders get trapped. That's much more significant. And then finally on to correlated markets, where we can see mini crude is on our side, it's ticking up, and natural gas is just back to neutral. So the overall picture here is quite simple. We have the market on our side, we have balance of trade on our side, but we've run into a wall, okay? We're 6 ticks away from our entry price, so we do have time to get out if that wall doesn't break. If that wall was 1 tick away from our entry price, we'd have a lot less time to make a decision, and in that case, it might be better to cut the trade. Now in the end, we did break this area of high volume, and then the market has popped, and kind of this is what I mean by the market popping. So we were stuck at 53.72 at this area of high volume. We got through that, and from a momentum perspective, we can see some nice, big, healthy numbers on the buy side here, and we can see gaps on the sell side here. We've now moved 13 ticks for our entry price, so we can say the market has popped our way. In terms of the balance of trade, we now have 1,000 more buy market orders than sell market orders traded, so balance of trade definitely on our side. We've left the high volume node to the left, as we said, taken off nicely as the shorts from this area got stopped out. Large traders, predominantly on the buy side, and we can see that the large traders are getting price progression for their efforts. So the last large buys were at 53.83, and we've now broken through that, we're at 53.84. The correlated markets also on our side. Now just note that like a lot of domes, they're set to recenter when price moves a certain amount, in this case 20 ticks. So in the case of natural gas, in the previous slide, we were actually at 17 here. So we've had a big pop up, it's just that the dome was recentered because we've moved so much. So what action do we take now from a trade management perspective? Well, it's up to you, but my suggestion is go make a cup of tea. So you can have too much of a good thing, and there's no point micromanaging a trade, because in my experience it always seems to result in me getting out earlier. So in this case we've got now high volume nodes above us. It might be prudent just to let the trade play out. In other words, you use these trade management techniques to manage the early part of a trade, and after that just let the trade play out. And if I thought of it like piloting a plane, it'd be a case of taking care of the takeoff and then switching on the autopilot to let the trade work out. So the earlier part of the trade is the riskiest, so it makes sense for me to pay more attention then and just let the market play out afterwards. Okay, on to the second trade. Same drill. So what we're doing here is we've got this area of high volume on the volume profile. We've got a market that's kind of moving sideways, just popped through the bottom of this consolidation area here, and we're taking along, so kind of presuming that this range is in force. So we can see the market just had a couple of bounces off this area. No real areas of high volume anywhere to trade off. And in terms of liquidity, there's no significant liquidity apart from up here at 52 and down here at 51.50. Now as before, the meter, the current trades, they've reset, all the DUMs recentered, we've got an entry long at 51.76. Okay, now we've all been here before, entered a trade and it immediately goes against you. In this case, it went against us within seconds. Now from a momentum perspective, this isn't a huge move, okay? But it was fast. And we can see 18, 21, 84, 88 contracts of sell market orders respectively at each price on the way down. Trade is imbalanced, but there's not a huge amount of trade overall. But there are more than 4 times sellers to buyers. Now for me, 200 contracts, 250 contracts is not really enough to make a decision. So I'd like to see more trade before using this to make a decision. There's no high volume below us. If you remember in the previous trade, we paused when we hit a high volume area on the way up. So we traded higher than normal volume in an area, and then we came back to that area and we did the same thing again. What we have below us is pretty much the opposite of that, an absence of high volume below. So there's nothing below us to actually slow us down. In fact, if you look at this vertical move on the left, we are actually at risk of a similar size vertical move down because of how few contracts traded on the way up. So the high volume nodes give us a line in the sand, a possible stopping point, but they're also our friend in terms of slowing the market down a bit and giving us time to make a decision. Now the 50 buy market orders here at 51.75, that was the top of the tape in the previous slide. So we can see not a lot of large trade, but it's certainly imbalanced to the sell side. And the correlated markets, other markets, completely flat, don't see an above the board, across the board drop. So this picture, it's not ideal, but it's not terrible. Markets moved against us 4 ticks. We're entering against overall momentum. The market is moving down here. Momentum is to the downside. We can't expect to buy the exact tick on a reversal trade, right? Especially on a market like crude. So we've only moved 4 ticks. Correlated markets are holding. Hasn't been that much trade. It's not clear. And in the absence of a clear signal, we're going to wait. And now we've moved back up again, which is absolutely fantastic, right? Well, it is good if price is your only reference point. Then this trade is doing much better. But maybe this is just me. But in my experience, I've had many trades move against me initially, come back to where I've entered, and give me a perfectly good opportunity to exit the market that I then ignored, only to watch the market then move against me again. So when a market moves against me and then comes back, I actually want to see some momentum on my side on the way back. I want to see the markets at least come back to balance. I want to see some big trades on my side. I want to see the other markets supporting me. Now from a momentum perspective, we moved up, we got as high as 51.76, but we still have a lot more trade on the sell side. In fact, we just saw another 94 sell market orders hit 51.75, and the market ticked down now to 51.74. So not only do we not have momentum on our side, it looks like the sellers are starting to jump back in. In terms of balance, we got 364 sells, 190 buys. A bit better, but still almost 2 times sellers to buyers at market. There is still no high volume to play up below us, obviously, and we've got a few more large traders coming in at 51.75 and 51.74. So at the same time, both the mini crude and natural gas are now heading down. So at this point, I'm actually taking the opportunity to try and get out. And this is a personal preference of mine. If a market moves against me, then when it moves my way, I want to see something positive on my side. And in this case, it's obvious that the move up is weaker than the move against us. So basically, I'm trying to get out of the trade. Now, there is no reason you couldn't wait for a little more confirmation here. We're just 1 tick in loss after all. So what we're looking at, with all these different things, we're looking at supplementary information, and there's no reason you have to use it exactly as I'm describing. You can adjust how you react to it based on your own risk appetite. So for me, this void below makes this something I don't want to hang on to, because I don't want to sit through a vertical move down that mirrors this vertical move up. And as we can see, the market did indeed push down after the exit. So it's now 8 ticks below our entry point. We can see all of the markets moving down together. We can see a nice imbalance on the sell side, lots of trade coming in, large sellers getting their way. We do have some large buyers, but they're just not getting anything for their money. Okay, one more example. This time we look at a thicker market, the S&P 500 futures. In fact, it's a different type of market from crude. It's much less volatile. And again, what we've got a long, this is a breakout trade, and here we are just a few seconds after entry. So let's orient ourselves to how we're going to manage trades on this less volatile market. Now in terms of momentum, we don't see any momentum yet, but what we do see already are much larger numbers. It's a different market, different amount of trade. So trade is balanced, again, 362 to 370. On this particular market, you want to see numbers in the thousands before you use them to make a decision. So even this was 300 sells against 50 buys, it's simply not enough trade to make any kind of decision on the S&P 500. Now we can see that immediately below us we had this kind of spread out area of high volume, and what happened was we got the large trade circle here. We can see, oh sorry, the area of high volume we're talking about is here. We can see this on the split profile here. We can also see about 5,000 on the sell side, about 5,000 on the buy side here. So we've got this area of high volume. This circle also represents that same area. But that's a little bit close to where we are now, and it might be a little bit too close to consider that a make or break point for this trade. I mean, to have a trade that's like, you know, 1 or 2 ticks stop on a breakout trade is kind of asking a lot. And plus it's just one circle. If we look a bit lower down, we have something that's a bit more significant. So we can see the market pushed up and we traded high volume, moved back down. And then we had a little head fake. So basically the market pushed up just a few ticks through that area, traded high volume, moved down again. Same thing again. We pushed up through that area, traded high volume and moved down again. And what we're seeing there basically is the market's getting held as we move up, and finally we have the break to the upside. So in my opinion, that makes this area here an area we should hold down. You should hold if we move down. So if we come down to there, we should bounce up. If we don't, then I'd consider the trade failed. Now, large traders did a lot of selling into 97.75 and 97.50, but so far they didn't get any price progression for their efforts. So all of these sellers here, they're putting orders here, have gotten nothing. In terms of correlated markets, what we've got here is the Dow Jones and the Nasdaq, and we can see that earlier in the day, especially this part of the day, they were basically doing their own thing. Markets had no energy, and in turn, at that same time, the S&P 500 futures were going sideways. So I think charts are okay for correlated markets when, as in this case, the correlated markets are more volatile than the one you're trading. So if you're trading slower correlated markets, it's going to be harder to identify those smaller moves on the chart, and you might be better off using a dome to look at those markets. Okay, so the market moves against us. So in terms of momentum, we certainly have a degree of risk here. You know, we're moving down, but we can see it's taken a lot of contracts to move through these bids. So this 1270 here, 539, 1154 contracts, that's how much it needed to trade to get those ticks down. So generally speaking, when you have a momentum move, these bidders, the bidders are getting out of the way. Okay, so you don't see such relatively large numbers to move through each price. And this is a market that, yes, we have selling, but it's not really moving well, even though it's moving down. It's like kind of running through deep mud. So this isn't great. It's not really what we want to see, but we do have a chance as stuck sellers. Trade overall, fairly balanced, 4,099 sells, 4,689 buys. Overall volume is good, but for the S&P 500, you really do want to see buyers overwhelm the sellers or sellers overwhelm the buyers before you make a decision. So as I said before, 1.5 to 2 times buyers to sellers in a momentum move up is normal. So basically, to me, this one's neutral. Yeah, we do have another couple of large trade circles. So we are building volume here. And in an intraday trend up, it's normal to move, build some volume in an area, move up again, build some volume in an area, and keep repeating that process. And we shouldn't stay in those volume areas too long. So it's possible that we're going to stick here and continue to build volume in that area. And if that happens, this area of high volume from 9750 to 9775 will most likely grow in both directions as we rotate around it. And that is not what we want to see for a breakout trade, okay? Because that's not breaking out, right? But the chance of the market letting us out of break, even if that happens, is actually pretty good. So if we start building volume around here, my premise for a breakout trade is dead. And that's where we potentially develop into a random trade. So it's a breakout trade, and if it doesn't break out, it's just a random trade. I'm staying in the market for all the wrong reasons. Now we want to see is a move away, up, away from this high volume area to the upside. If it moves down a few more ticks, we might see some of the buyers from this area get stopped out, and that will give us a swift move against us, very likely to push down to the prior high volume area down here. So we're very much on the wrong side of high volume right now. In terms of large traders, we can see more sellers came in recently, but again, something we need to keep an eye on because they are getting a little bit of price progression, but not much. The correlated markets actually pretty flat. These are volatile markets, and when you see them move, it should be very obvious. So right now, these markets are both flat. So right now, we're 2 ticks offside, trade is balanced, we are on the wrong side of high volume area, and we do have sellers hitting the market, but not really getting any momentum. Other markets are flat, and the bidders are absorbing selling. So in this case, you could decide either way, keep the trade or cut it. But in my opinion, you just don't want to overanalyze this. So if I look at that, I can look at that and in a few seconds I say, that's not really clear. And it's going to be like that. It's not as if you can always know all of the time whether your trade is working or not. But a lot of the time, it will be very clear. And at some point with every trade, it will absolutely become clear. So we're not at the point where it's become clear yet. So given we're just a few ticks offside, we can wait for that clarity. And this is important because you don't want to be giving yourself a headache trying to figure out what's going on when it's not clear. If you keep it fairly simple, looking for obvious signs that the market is with you or against you, just accept that sometimes it will be unclear. That then you'll have a fairly fast and efficient decision-making process. Okay, and now we have a little bit more clarity. So on the momentum side, we've got upside progression, and apart from 98.25 here, it's not taking too much buying to each price. The angle of ascent on the chart here is quite vertical, shows that was a fairly fast move. If we look at the balance of trade, just under 8,000 sells, 11,000 buys, we've got the imbalance. The high volume area now is below us, and that becomes a line in the sand for us. So if we do move down again, we really should not be able to move down past this area. And if we do, premise for the breakout is dead, and the buyers in this area look to possibly get stopped out. Large traders, predominantly on the buy side, and when you look at this, if you look at the tape, if there's 12 sells and 13 buys, doesn't mean much, so don't get caught up with counting each one. I've got 1, 2, 3, 4 on this side, 1, 2, 3 on that side. A quick glance will tell you if it's mixed or one-sided. Okay, if you can't see if it's one-sided, it's mixed. So in this case, it's one-sided, especially recently. But also we can see, with the exception of this fallback to 97.75 here, the buyers didn't have to suffer the market ticking back against them at all. The sellers having a really bad time. And for correlated markets, this is what I mean. If you look at the NASDAQ here, that's what I mean by seeing the market like the NASDAQ and the Dow pop. As we know, they're more volatile than the S&P, so they tend to give you fairly obvious signals. And we can take two things from this. One is the fact that they're moving together, which indicates good, healthy overall participation. And second, obviously, the fact that they're moving up. So just to reiterate, if these were correlated markets that were slower than the S&P 500, charts would actually be a tough read, and you would be much better off using a dome. And finally, to the point where we might be better off going for a cup of tea instead of managing the trade. So we traded a breakout. The market moved sideways a little after our entry, and then finally it broke our way. We got the pop that told us, yes, we were right about that break. So when it was moving sideways, we didn't have a clear indication which way it would break. We had mixed signals, so we waited till something became clear. So if it's not clear, you get out or you wait until it is clear. What you don't try and do is overanalyze what's happened since your entry to force yourself to make a decision on insufficient information. Okay, so now would be a good time to post any questions you have. And what we're seeing today is simply the use of additional information for managing trades. And it makes sense to me to adopt one element of information at a time to avoid confusion, but it also makes sense to look at this as just information you can use in any way. So I use this information in a certain way, and you might find different ways to use it. You might find that certain things work well on some markets and certain things don't work so well. You might find certain things work better on longer term trades and some things work better on shorter term trades. Now the software you've seen today is part of the Jigsaw Trading Toolkit, award-winning software that comes as a plugin to various trading platforms as well as a standalone platform. you get both tools and the educational materials to use them. In fact, the educational materials we have freely available on our site is in use by prop shops around the world as part of their trader education programs. We have a strong community of traders using the tools. We have a free chat room that's active in the US trading session where customers come to discuss markets, using the tools, and of course we talk about our trades. Tools themselves retail at just $399.99 and they come with a no questions asked money back guarantee. The tools are not for everybody, okay? What we do offer is genuine, no BS tools and education to really make a difference to your trading. Now, if I can see the questions, can I see questions anywhere? Let me just try and find the questions. Oh, thanks for showing a loser. Matt, I get plenty of those. One of the key things about managing trades is trying to make your losers as small as possible. It really is key. If you can do that and not worry about where it goes afterwards, you will really benefit from this. What would you look for on ES when you are fading with a limit entry versus trading a breakout? Well, breakout trades, Najib, they're actually the worst trades to take because with a breakout trade you really need it to pop or it's really going to move against you fairly quickly. If you're fading a market, there's different ways you can fade a market. You could be looking for the day high, you could be looking for a pullback, is still kind of fading the market, or you could be fading a range. I would say if you're fading, trying to sell the high of the day, that's very tricky, and I would be looking for some momentum very early in the trade. If I was trading a pullback, so the market's moving up overall and the market pulls back down, really I'm a lot more patient and I've got a lot more time in the trade. And I expect it to take a while for momentum to kick in. So really what's going to happen, market pulls back down, starts to move up, and it'll be a while before everybody sees that, and then the momentum kicks in. So on a full reversal, I want momentum to kick in straight away. And then you've got the kind of range bound market reversals, again, a bit more like the pullback, where you kind of have to wait a little bit of time before people see it and start to jump on that trade. Liquidity vacuum. Matt, I'm going to stay away from liquidity vacuum because a lot of people in here really don't know what that means. But basically, a liquidity vacuum is basically when a market pulls back on weak volume. And actually, Renee, I think on that, it's at 2:30. I don't want to run over. So if you do like what you saw today, come over to the website. There's a lot of educational material on there, a lot of stuff you can see. You don't need to register, you don't need to pay anything. And feel free to get in touch. My contact details are here.